Everyone, it's David from Power here. Welcome to another episode of Invest Power today. I'm very excited about what we want to talk about today because everybody is wanting to know how to increase their borrowing capacity. Every time when I've got clients coming to me, and I hate to say this, but I get a lot of people who's expecting they're able to borrow this much. But after all the assessment, I have to tell them you can only borrow that much. And as you can imagine, their face just goes right in. And you can tell, well, and you know, they start asking questions like, oh, so can we use a different lender? How else can we increase my borrowing capacity? I really want to buy a home in Sydney. I know it's so expensive. What do I need to do? So I thought, in preparation for that, there's a couple of things that I'm seeing as a common trend, which I thought I'll share today. And you can have a look, and there's a couple of things that you can do yourself before you even see a mortgage broker or go and see any banks, so that you've got your ducks lined up and you know that you're walking in with a maximum borrowing capacity to your advantage. Okay, so I thought that's what we're trying to cover today. So let's get into it. Broadly speaking, 3 categories in terms of how banks assess your borrowing capacity. Your income, so how much money is available for servicing the loan. Liability, what exactly is the existing liabilities that you currently have? That's basically that's taking away, that's basically using up your money in a certain extent. And also living expenses. So this is one that's been cracked down a lot lately. How much is your living expenses as a monthly expenses, which we all know that we cannot live without. So banks are now very tight about living expenses as well. So I thought I'll cover that briefly in today's discussion. But first of all, in the income column, most importantly, it's the salary. Okay, so the salary directly impacts how much you can borrow, because it is fundamentally how much money you've got, how much surplus money you've got left over in order to be able to service extra debt. That's the bottom line. That's what banks are looking at. So the higher salary that you have, the more advantage that you are in able to get a higher loan. So if you haven't negotiated with your lender, if you haven't negotiated with your employer, then start negotiating with them to see whether you can get a raise. Or alternatively, if you've got bonus, if you've got 2 years of bonus that's on your tax return that you get show, then that bonus can be used as well. I'm seeing a lot of clients who's only got 1 year of bonus. Some lenders will consider that too, but most lenders will only consider 2 years consistent bonus, and you need to show it on a tax return, or you need to have an employer letter basically states this is the amount of bonus that you're getting for the last 2 years. Okay, so it's all about consistency. One-stop bonus cannot be used. It needs to be consistent for 2 years. So if you can't get a salary rise, maybe it's time to talk to them about maybe getting some incentive bonus. So that will help in terms of servicing as well. On top of that, if you got rental income, that will definitely help as well. So the more investment property that you have, which is providing you a good cash flow of income, that will get seen favourably from the bank. So instead of just say, for example, I'm earning $80,000 a year with a bonus $5,000 for the last 2 years, if you got rental income of say $20,000 from one property, then that all adds up. So instead of just saying your total income or serviceability is 85,000, you add up 85,000 plus another 20,000 for servicing purposes. Okay, so that all gets added up as well. So if you haven't reviewed your rental, or if you just left the property running for a while, you haven't really checked in terms of what the market rent should be, speak to your PM to see, property manager, to see whether it's time to actually look at reviewing that rent and bump it up. Okay, so I know that could potentially be something that you can do as well. Last but not least, and I know that we all hate this, but if you want to be able to get that dream home of yours and you really can't get another raise, you may want to consider getting a second or third job. I hate to say this, but things such as Uber, or Saturday, you can get another casual job. you know, that kind of stuff. So to improve your income, you know, to improve your income as well as your deposit. So these are a couple of things that you can increase in the income column. Let's have a look at liabilities then. So first and foremost, existing mortgage. So that will definitely have the biggest impact in terms of your borrowing capacity. How much have you already borrowed so far? So, and that will directly impact, that's for sure. So if you only borrow $20,000 and you've got a relatively good income, then that will get assessed favorably by the bank. You go, he's got a lot more servicing capacity, therefore we're confident that we can actually lend him an extra $500,000, for example. So your existing mortgage, if you've been paying it down as P&I, fantastic. If you're on interest only, then that does not get looked at favorably by lenders at the moment. Unfortunately, because you're not paying down the debt continues to get accumulate and it continues to stay there. So that will unfortunately have an impact unless your income increases and improves significantly. Otherwise, your borrowing capacity, assuming that the existing mortgage stays the same and not going down, as you can imagine, is going to have a struggle to get a lot more money. Credit card is another one. So credit card limit is actually the main killer to a lot of borrowing capacity. If you've got credit cards that you're not using, my suggestion is get rid of them. Because what happens is credit cards are being assessed at 3% of the limit. So if you got, $15,000 credit card limit, at 3%, that's $450 as an existing commitment every month. So if you're not using that, definitely reduce it down is my personal suggestion. Okay. Personal loan or car loan. So this is quite common. People get personal loan for various reasons. Now, personal loan does have a very high interest rate, and again, for banks to assess personal loan, we're just looking at an existing commitment every month. And usually that personal loan, due to the nature of the high interest rate, will actually get assessed at a higher repayment. Therefore, from a monthly commitment perspective, you're going to be paying a lot more in the personal loan, car loan space than your existing mortgage. That's what we're seeing at the moment. So you want to be better off paying these off and maybe get a cash out in order to pay these off if there's an opportunity to, because the cash out will get assessed at a lower ongoing commitment, or may potentially get assessed at a lower ongoing commitment than personal loan and car loan. So my advice, if you've got extra money, get rid of these personal loan and car loan as quickly as you can, because they're not taking you anywhere in terms of borrowing capacity. HECS and HELP. So student loans, essentially. What it is these student loans, if you look on the ATO website, HECS and HELP, they have a way of calculating the repayments as well. So everyone's under the impression that, okay, only my income is over a certain threshold and I will need to make the minimum repayment for the HECS and HELP. But when it comes to serviceability and assessment scenarios, this is not the case, because banks will use that table according to ATO on how they will be treating that monthly repayment, and it's ongoing as well. So to a certain extent, HECS and HELP are like personal loan and car loan as well, not looked at favorably. So if you've got spare cash or if you've got extra money, let's get the HECS and HELP out of the way. I've got clients who's taken cash out just so that we can try to get rid of the HECS and HELP. And as soon as that's gone, the borrowing capacity increases significantly. So that gives you the difference. Okay, last but not least, expenses column. Okay, so expenses column, two broad categories: basic living expenses and discretionary living expenses. What do I mean by basic living expenses here? So basic living expenses are like groceries, clothing, transport, mobile phone, these kind of stuff. You know, if you don't know how much you're spending each month on it, my suggestion for you is download the ASIC budget tracker app and start doing some budgeting, because if you are not doing it, my suggestion is you should be on top of it so that you know each month where the money is going out to. You know the money is coming in, that's the easy part, but most people have trouble understanding where the money is going out. So use that, because when it comes to assessment and when brokers are being involved, we do need to actually provide itemized living expenses categories. So we'll sit down with you, have that conversation and go, here is your living expenses, here's what your bank statements are telling me, and most of my clients actually look very shocked because it's a lot higher than what they thought and what they initially thought. So if you're not on top of your basic living expenses budget, start today. Discretionary. Discretionary spending is things such as holidays, for example. That's an easy example. Discretionary spending, we all know that we need it, but you know, there's definitely ways that we can cut that down as well. For example, you might do every 2 years you might go for international travel. Look, you could probably change that to a domestic travel, or every 4 years instead of 2 years. So there's a couple of ways that you can reduce that discretionary spending in order to increase your borrowing capacity. But the most important part again here is use that budget tracker so that you can do some budgeting and understanding where your expenses are going and where your money is flowing. Okay, so that's my advice for you under the expenses column. Alright, so I hope that what I covered today actually helps. Hopefully it gives everyone a bit of idea on what they could do, and in order to increase their borrowing capacity if they're looking at getting a new home. I'll hate to see more faces coming to me and being very disappointed, walking away very disappointing, only knowing that they can only borrow so much. So yeah, that's what I want to cover today. If you got any questions about today's content, just leave me a message below, or you can drop me an email. If you like this video, please click on the like button and subscribe to our channel. We'll have more future contents coming up as well for investment power. Until then, I will see you next time.